Hey guys, welcome back to the channel. Inflation is everywhere and always a monetary phenomenon. Milton Friedman told us that. He's a professor from the Chicago School of Economics. You could consider him an Austrian economist who's kind of hanging out with Hayek and the rest of the guys over there. Rothbard would be in that group. Mises would be in that group. But he was more of a monetarist, where he viewed economics through the lens of monetary policy. There's another guy who talked a lot about money, and his name was King Solomon. So what I typically do is I read a proverb a day that correlates with the day of the month. Today is the 20th, and today in Proverbs 20, he writes, "Differing weights and differing measures, the Lord detests them both." And then he writes again in 15, "Gold there is, rubies in abundance, but lips that speak knowledge are a rare jewel," which is really something interesting to think about. And I've been studying this guy, King Solomon, and studying how much wealth this guy had, and it is insane. It is absolutely insane how much, because I've been breaking down the amount of gold that they say he put in these shields and in his chariots and in his tables and his all these type of things, and they break it into talents, and talents are like 10,000 ounces. Anyway, this guy had a tremendous amount of wealth, but he also writes, "The Lord detests differing weights, and dishonest scales do not please him," which is interesting. So what we're discussing today is this idea that money is just a weight. It's just a unit to scale barterability, essentially, right? Like I offer you a good and you want it, and we need a medium of exchange, a third party, if you will, a rock, a piece of metal, some sort of code. We need something that's just like, yo, this is good with us. So that way I'm not in this weird situation where I got to trade you 20 chickens for one cow. And you're like, I don't need 20 chickens. I just need I need some chicken, but not a lot of chicken, but I want to get chicken, I want to get more like next week, but I don't want it to spoil on me or something like that. So you want to hold your wealth in money, which totally makes sense. Milton Friedman broke this down, and he viewed everything from monetary policy, most things. And it's interesting because he says inflation is everywhere and always a monetary phenomenon. Well, the Austrian School of Economics would define inflation as an increase in the money supply. So the Austrians, and if you want to think of the pure Austrian economics, School of Economics, and the most pure form, Peter Schiff is the living legend of Austrian economics. He does a better job at teaching the ideas of Austrian economics more so than anyone else. I think he's wrong on a few things, but he knows it in and out. And so when you listen to a guy like Peter Schiff, he will talk about, inflation is money printing. Inflation is an expansion of the money supply by definition. If you listen to a guy like Jim Rickards, he will be like, actually, if there's no velocity, you don't have inflation. And what he's saying is, I could print $1 trillion, give it to your boy Trav, and if Trav stuffs it away in a bank account somewhere and it doesn't move, technically there's no inflation inside of the real economy. Peter Schiff would go, no, I'm looking at it like a video game from the top down, and I want to know how many units of currency are in this game. And just the fact that Trav has all this monetary energy that at any point in time he could slam down on the table and be like, yo, $1 trillion of value coming my way. And we live in a society where people will be like, oh, dollars, let's take those. But throughout history, different things have different values. So we're at a spot where the dollar is starting, not completely yet, but it is starting to lose some of its monetary energy. Meaning if I got $1 million sitting in my pocket, and I can expend it, and I can grab $1 million of value. Well, now our government tells us it's losing about 9%, 8 to 9% a year in purchasing power. So next year, you're not gonna have $1 million of today's purchasing power. Next year, you're gonna have like $910,000, $920,000 of purchasing power. The real kicker is when you compound that into the next year, because it's not that you're losing 8% again, you're losing 8% on your baseline of $1 million. So it gets really weird. I want to propose an idea that I was discussing with my buddy where he's like, dude, I think Milton Friedman was wrong on inflation is everywhere and always a monetary phenomenon. And we were taught, and most people are taught, that inflation, or the key to bringing inflation down, is to cut the demand, which the easiest way to cut the demand is to increase the price of money. So the Fed is raising interest rates. We're waiting a day or tomorrow. They're going to come out and be like, oh, I think it's tomorrow. Oh, we're going to increase the interest rates. We're going to stay right here. And the stock market's on edge. And as they're increasing the interest rates, we're seeing the market kind of drop off, because as your scale, if you will, is the cost of dollars, is the cost of these like fiat units of currency. And what we're finding is that it's not a good scale because it has a differing weight. It's constantly changing. It's not forever and always solid. If you look at inflation in America, you don't see inflation until you get to like 1920s, 1930s. You really don't see any inflation, like hardly, until you get to the 1970s. And that's a debasement of the currency. But up until that point, we're basically using gold and silver and copper to measure the cost of eggs, a gallon of milk, a house. I mean, you look at housing prices, they basically are flat until 71. And then there's this big debasement, and we then use oil as the weight. So instead of using gold, we're now like getting rid of gold as the monetary weight of the US currency, and we're replacing it with the petrodollar in 1974. And that worked totally fine all the way up until about 2020, 2022 for sure, where we broke this tie. And I'm gonna go into a theory that Luke Groman has on, if you look at gold priced, if you look at oil priced in gold, you will notice it has stayed in a range between $10 and $15 mostly, $20 at the peaks. We just recently broke that. So now like we basically are going through another devaluation. So if you wanted to see where the dollar is going from here, you could look at a chart from the 1970s and you could see what happened in 74. And you basically from 71 to 74, there's this debasement. Well, from 1932 to 1933, there's this debasement when they take the gold basically and they're like, it's not worth $20 an ounce anymore. It's worth $35 an ounce. They reprice it and they basically take 45% of everyone's everyone's net worth measured in US currency units, and they just drop it by 45% and they debase. They do the exact same thing in 1970s. And we're at the spot right now where they're doing the exact same thing. However, Milton Friedman may have been wrong on saying, well, inflation is everywhere and always a monetary phenomenon. It's not, if it's the supply that is now breaking off. Milton Friedman always assumed that supply was fixed, relatively fixed. Supply does come down when the cost of money goes up because you just can't produce as much. If you think about buying a factory or building a building, if the cost of building that building doubles on you because the interest rates went way up, then you're like, I can't produce as much. So the cost of the things I'm going to produce are going to cost more. Well, Milton Friedman would look at this and go, well, yeah, it's a monetary phenomenon. Well, we're actually seeing supply chains break down, and we're seeing reshoring, and we're seeing deglobalization. And so what's interesting is it may not be a monetary phenomenon. It may not be how many currency units are printed. What actually may be dictating it at this point in time is the supply and the available supply. The demand, up or down, whether we can crush demand by increasing interest rates and dropping the stock market and like pulling some of these bubbles out, because like housing bubbles gone way up, stocks have gone way up, crypto's gone way up, and I'm super bullish on crypto long term, but it just went way up too fast. It's just like anything that does a 10x in 12 months is like, it's hot, it's too hot, gotta chill it out. So I want to propose that perhaps what we're seeing is a breakdown in supply chains, and that this is going to continue to snowball, and that they can't solve the inflation. And if they can't solve the inflation, then what we have to do is we've literally say any excess that we have in the system, we've got to get things or items that are outside of that system. That's why I promote silver and gold as a gold and silver broker. Like, this is what I do in the mornings. I get on the phone with you guys. My number's listed below. You can call me, text me, like, I'm happy to help you. But what we're essentially doing is saying, oh, the US is going through its third devaluation. And this devaluation is a reset. It's on that 80 to 100 year, like, oh, we're gonna change. We're not gonna use the continental dollar anymore in the United States. We're gonna use a different dollar, right? Well, now we might be using the digital dollar. Well, all of these things are gonna get repriced. And what you wanna do, you wanna position yourself in a spot to have assets that when they're repriced, they will still hold the same monetary energy. What we really want in money, what we really want out of it, is we want it to be stored like a battery, and we don't want that battery to lose 9% of its net worth every single year. I mean, if that's our only option, then that's fine. And there is a point where you need to store some cash. You need to have cash. And like Rick Rule would say, it's the cost, the inflation on cash is the cost of owning the option payment. Like, I consider cash an option, like an optional cost. So he has a point there, but you don't want to hold it forever and always because it is losing value. And we are entering into a new currency. They devalued in 33 by 45%. They then again devalued another 45% in 74. We're at the end, where if you took at the original US dollar, it buys 99% less than it used to buy. So it's totally been fine with just a little bit, just a little bit, just a little bit. But it's that last 1% and that last 1.5% where everything changes. And it will happen like that. See you guys down in the comments below. Let me know what you guys thought about this. And until next one.